Hi, welcome back. Now we started discussing implied forward rate in the previous class. We said it's a rate that makes you indifferent between investing in a longer term bond or investing in a shorter term bond and investing the proceeds for a short term. Now in this class, we want to look at the forward curve. We want to see how we can derive the spot curve or the spot rates from the forward rates and also price a bond using these both the forward rates and the spot rates. Now let's say we have this table on the screen. Now you have the time periods and the forward rate. Here you have this 0 year, 1 year implied forward rate 1.5%, the 1 year implied forward rate as 2.4%, the 2 year 1 year implied forward rate as 3.2%. Now derive the spot curve series of spot rates from this. Now we are going to do this using a geometric linking, geometric averages. Now the 0 year, 1 year, what we are looking for here is the spot rate, so we can price a bond. Now the 1 year spot rate is basically the 0 year, 1 year implied forward rate, which is 1.5%. We don't need any calculation there. Now for the second year, you need to link the first forward rate to the second forward rate. So basically it's a geometric average. You multiply this by this to derive 1.949. Then for the third year spot rate, you link the three forward rates together to get 2.364%. Now assume an analyst wants to value a 3.5% 3-year bond using both the spot rates and the forward rates and the rates computed above. Now using the spot rates, how do you derive the present value of the bond? Now what you do here is to discount the cash flows. Now the first discount rate is the forward rates, which is 1.5%. Now the second discount rate, we already derived this spot rates, which is 1.949%. And finally, the third spot rate is 2.364%. If you put that into the equation, you have your present value of the bond as 103.30935. You are discounting the various cash flows by the different spot rates. Okay, now you can also derive the yield curve. You can also derive the present value of the bond using forward rates. In that case, you combine the rates. But let's not go into those complications. Now let's discuss another concept: yield spreads. Now yield spread is the difference between the yield on a bond and a reference or benchmark yield. Changes in a bond yields are largely driven by both macroeconomic or microeconomic factors. Macroeconomic factors are factors that are peculiar to, they are systemic factors that affect every other bond issuers in the economy, e.g. changes in expected inflation, the general economic conditions, the business cycle, and then foreign exchange rates, and the impact of monetary and fiscal policies. These variables affect every bond issuer in the market. Now, but macroeconomic factors refers to firm-specific, bond-specific factors. Now, these are credit risk, the tax status, liquidity risk, and some other factors. Now, the higher the risk, the higher the spread, and vice versa. Now, let's look at the yield on a corporate bond or risky bond. Now, this can be expressed as the expected real rate plus expected inflation, add the credit risk, liquidity risk, and the taxation. Now, this is for a risky bond. Now, but for a benchmark bond, like a government treasury bond, now the expression is R subscript F. Now, this is given as expected real rate plus expected inflation. Now, the difference between these two bonds are basically the premiums. You have a credit risk, liquidity risk, and taxation for a risky bond. But for a government bond, we don't expect, there's no credit risk because there's no default. We also expect that the government bond trades frequently, so there's no liquidity risk, as well as most of them are also tax exempt, so there's no taxation premium. Now, these last three components, the credit risk, liquidity risk, and taxation, are together referred to as the risk premium or the spread. Now, yields on most fixed rate risky bonds are benchmarked to yields on the run recently government bonds. What we are saying is most bonds are quoted as they are reference to recently issued government bonds. Now, for floating rate bonds, the popular benchmark is LIBOR. LIBOR is the London Interbank offered rate. Now, there's a spread also called I spread, interpolated spread. It's a spread over the swap curve. Is the yield spread over the standard swap rate in the same currency or bonds of similar tenor. Now, there's also what we call spread over LIBOR. These are used to compute the credit and liquidity risk of a bond against a benchmark interbank rate. Now, LIBOR spread is also used by issuers to compare the cost of a fixed rate bond compared to that of a floating rate bond. Now, for investors, the LIBOR spread can be used to gauge the level of credit risk. There's also G spread. Now, the G spread is the government spread. It's the spread of a bond's yield over that of a government bond yield. It could be actual or interpolated spread. Now, yield spreads over the benchmark yield curve. Now, this shows the relationship between the yields to maturity and times to maturity of a bond with identical risk profile. Now, for a risk-free bond, the yield curve shows the relationship between yields to maturity of on-the-run issues and their respective times to maturity. We are talking about a risk-free bond of different times to maturity. Now, there's also what we call a swap yield curve. Now, this plots the relationship between a swap rates and their times to maturity, and basically linking the different swap yields at different times to maturity. There's also a credit curve. If you can decompose the credit risk component from the yield curve and link the various points, what you have there, what you derive is basically the credit. It's a credit curve. Okay. Now, the next thing is to account for credit risk over the term structure. Sometimes the G spread and I spread are used as a constant discount rate for the cash flows. Now, another interesting spread you need to understand is what we call the zero volatility spread. Now, this is adding a constant yield spread over a government or interest rate swap spot curve. And we call that the zero volatility spread, the Z spread. Sometimes it's also called the static spread because it assumes zero volatility. And this can be calculated using the option adjusted spread of a callable bond. Now, you need to be acquainted with this because in the course of the program in level 2 and level 3, you're going to come across this option adjusted spread, also called OS. It's basically the Z spread, the zero volatility spread, minus the option value. Now, the value of the embedded option in the callable bond is derived from an option pricing model that assumes future interest rate volatility. Now, let's take an example, illustration 15. Estimate the G spread for an 8% annual corporate bond with 2 years to maturity and priced at 103 if the government benchmark bond with 2 years to maturity pays a 6% coupon bond and priced at 104. Now, we want to calculate the G spread, the government spread between a risky bond and a risk-free bond. And what we're doing here is calculate the yield spread on the government bond, the yield spread on the risky bond, and then find a difference. So the yield to maturity for the corporate bond is determined as follows. It's very simple and clear, 6.35%. The yield to maturity for the government bond is 3.82%. The difference between them is 2.47%. That is 247 basis points. Now, this brings us to the end of this fascinating class, Introduction to Fixed Income Valuation, and also to the end of this topic. Now, I hope to see you in the next class. In the next class, we're going to be looking at Introduction to Asset-Backed Securities. It's a very interesting topic and very fascinating. Now, ensure you go through the end of chapter questions we posted at the end of this chapter to reinforce the concepts. Now, try them over and over. By the time you try them over and over, you get used to them, and then you master the concepts. Don't be so engrossed in the calculation. Also try to understand the concept behind them. Send questions. I'm available to answer your questions. Thanks for watching.